JEPQ and QQQI are two dividend ETFs that have provided some great total returns, zero Nav erosion, double-digit high yields, and they pay out consistent monthly income. And while both these ETFs can still be good choices, there are plenty of other solid income ETFs that are out there that perform just as well, if not better. So in this video, I'll be talking about 6 high-yield ETFs for monthly dividends that have no Nav erosion. Starting off, we have tspy, the Tab Alpha SPY Growth and Daily Income ETF. Now, tspy's primary objective is that it seeks to generate income while also offering the potential for appreciation, and its secondary objective is to seek exposure to the performance of the SPDR S&P 500 ETF SPY. It aims to achieve its objectives through direct exposure to the S&P 500 for capital appreciation opportunities. And they do this by holding the ETF SPY, which tracks the S&P 500 index. Second is income generation through their covered call strategy, which is the monthly income that it provides. Third is maximized time decay by utilizing 0 DTE option positions. And 0 DTE is 0 days to expiration options, so these options expire at the end of the current trading day. Fourth is that you have reduced time risk from the 0 DTE options since they minimize prolonged market exposure, as well as it offers flexibility in that the fund can adjust its positions based on market conditions. tspy also uses S&P 500 index options, which are classified as 1256 contracts from the IRS, where 60% of the income is taxed as long-term capital gains and 40% as short-term, regardless of how long the position is held. tspy has an expense ratio of 0.77%, which would cost you $77 for every $10,000 invested. For the top holdings, this fund pretty much just has one, and that's because it gets exposure to the S&P 500 through the SPY ETF. And SPY's top holdings are names like Nvidia, Microsoft, Apple, Amazon, Google, and others. For the sectors that it's primarily exposed to, it's going to be technology at the top, financials, and consumer discretionary. So, in line with the same as you'd have in the S&P 500. Now for the dividends, tspy has a dividend yield of around 12.5%, which it pays out monthly. And if we take a look at the dividend history, you can see that it's been pretty steady in the time that it's been around. tspy has had pretty solid returns considering it's been around for just about a year now. But in the past year, it's had total returns including dividends of around 15%, so a job well done so far. For a pretty new fund, tspy is bringing in some nice competition to the other similar S&P 500 income funds, and the fact that it's seen zero Nav erosion is a big plus. With this strategy that uses 0 DTE options, tspy has managed to continue to provide some consistent and steady income. And if this is something that you're looking for, this could be a fund to look into. I'm definitely interested to see how it does in the future. Next up, we have qdvo, the Amplify CWP Growth and Income ETF. qdvo's primary investment objective is to provide capital appreciation, and its secondary objective is to generate high monthly income. This fund mostly contains large cap dividend growth stocks and is designed to offer high levels of total returns. So why should you invest in qdvo? First is for its growth and high income potential. It seeks capital appreciation from growth-oriented stocks with high monthly income from option premiums and dividends. qdvo does this with a portfolio that's diversified across a variety of growth stocks from the Russell 1000 Growth Index, and it sells call option contracts tactically to generate that additional income. Second is for equity exposure and lower volatility. Covered calls and dividends may help to reduce volatility versus the overall market during broad-based market declines. Third is for its active management. This allows the portfolio manager to identify opportunities and risk and act on those decisions in real time. And qdvo aims to provide an income of around 0 to 2% from the dividends of its holdings and 4 to 6% from its option premiums, plus the potential for capital appreciation. Getting to the fees, qdvo has an expense ratio of 0.55%, so not too crazy for an actively managed fund. For the holdings, qdvo contains around 52 holdings in total, with its top 10 holdings and many familiar names like Nvidia, Microsoft, Apple, Google, Netflix, and more. The top sectors that make up qdvo are going to be technology, communication, and then consumer discretionary, with the remaining percent sprinkled in a few other sectors. Shifting over to the dividends, qdvo has a dividend yield of 8.9%, which is paid out monthly. If we take a peek at the dividend payments, you can see there are just some slight fluctuations and that income has increased over the last few months. qdvo might surprise you when it comes to its performance. Since it was created a year ago in August 2024, it's had total returns of around 26%, some amazing first-year results. With its growth-oriented portfolio and tactical option strategy, qdvo shows some nice potential for a relatively new fund that's on the market. And if you're someone that's looking for a balance of a nice yield with some solid potential capital appreciation, then qdvo is one to look into more. Third on the list, we have gpiq, the Goldman Sachs Nasdaq 100 Core Premium Income ETF. gpiq seeks to provide current income along with the potential for capital appreciation. And there's 3 reasons to consider gpiq. One is that it seeks to generate consistent monthly income from option premiums and dividends. Second is that it offers core equity exposure with lower volatility. It does this by investing in a Nasdaq 100 index, and it uses a dynamic option strategy by selling call options on a percentage of the fund's holdings, which will depend on the current market conditions. And they adjust the percentage of the portfolio that they write call options on, which can vary from 25 up to 75%. And the third reason is for its diversifying source of income. When it comes to the cost, gpiq has an expense ratio of 0.29%, costing you $29 on $10,000 invested. So not so bad at all. gpiq contains a total of around 107 holdings, and its top holdings include Nvidia, Microsoft, Meta, Tesla, and Google. And the primary sectors that make up this fund are technology, communication, and consumer cyclical, so very similar holdings and sectors that you'd find for the Nasdaq 100. Getting into the dividends, gpiq has a dividend yield of 9.8%, and it pays that monthly. The last year of gpiq's dividend payments have been looking real good so far, providing some very consistent and stable income. When it comes to performance, gpiq was created in late October 2023, so it's not yet 2 years old, but since then, it's had total returns, including dividends, of nearly 57%, so some great results so far. With some pretty low fees compared to other actively managed funds, stable and consistent income, a nice high yield, and some capital appreciation to top it off, gpiq is proving to be a strong contender as a solid income ETF. Next up is ispy, the S&P 500 High Income ETF. This fund targets high monthly income while aiming to capture long-term returns. So why invest in ispy? Well, first is that it targets high income. The fund's covered call strategy uses daily options to generate high income from the call option premiums and the dividends of the holdings. Second is the opportunity of S&P 500 upside. By using daily call options, the cap on the price appreciation of the stock resets each day, allowing for more opportunities to benefit from gains of the market. This, plus the income from the option premiums, allows ispy to have close returns of the S&P 500. Third is that it aims to capture total returns that are missed by traditional cover call strategies, and this piggybacks from those benefits of using daily options. Let's talk about the cost. ispy has an expense ratio of 0.55%, costing you $55 for every $10,000 invested. ispy has a total of 509 holdings, and for the holdings of ispy, you'll notice it's very similar to the S&P 500 with the same familiar names of Nvidia, Microsoft, Apple, and more. For the sectors, the same thing goes, being very similar to what you'd see with the S&P 500. Jumping into the income, ispy has a dividend yield of over 11%, so it's very nice to see the double digits here, which it pays out monthly. If we take a look at the dividend payments from ispy, you'll notice that the payouts can fluctuate by quite a bit, as volatility in the market will play a big role. Keep in mind that ispy gains exposure to the sale of daily call options using swap agreements and does not trade options. When it comes to performance, ispy has had some pretty nice total returns, including dividends, of around 31% since its inception in December 2023. ispy is a solid cover call ETF that pays you a nice high yield, it offers you some upside potential, and it doesn't have any Nav erosion, as well as it gives you some nice diversification. Next is a much different fund, and that's BTCI, the NEOS Bitcoin High Income ETF. BTCI seeks to generate high monthly income with the potential for appreciation based on its exposure to Bitcoin through spot Bitcoin exchange traded products, or ETPs. There's three parts to BTIC's investment objective. First is that the fund invests in exchange traded spot Bitcoin ETPs. And spot Bitcoin ETPs are funds that track the price of Bitcoin by actually directly holding Bitcoin as their underlying asset, and the ETP price will move with the price of Bitcoin in crypto markets. Second is that BTCI gets synthetic Bitcoin exposure through ETFs that invest in Bitcoin future ETFs. And this is done by using an option strategy of selling put options and buying call options at the same strike price on one or more Bitcoin futures ETFs. And this synthetic exposure aims to behave like owning Bitcoin. And last, it utilizes a call option strategy to provide that high monthly income that mainly involves selling call options on a Bitcoin futures ETF. For the fees, BTCI has an expense ratio of 0.98%, and that's pretty high, but the rewards from this fund can make it worth it. Now, when it comes to the holdings of this fund, it of course is focused on Bitcoin, but you'll see there are a few different things listed, and you may be wondering what it is. So first, like I mentioned earlier, BTCI invests in ETPs, which currently the fund is holding HODL. Next, you'll see where BTCI creates synthetic positions with CBOE Bitcoin US ETF index options, which is CBTX, and if you see MBTX, that's just the mini. And then you have roughly 70% in treasury bills for collateral and some interest. As for the dividends for BTCI, it has a dividend yield of over 25%, which is pretty insane to say the least. Taking a look at the income it's provided since it's been around, it can vary from month to month, since the volatility of Bitcoin will be the main contributor to this. BTCI doesn't disappoint in its performance either. Since it was created in October 2024, it's had a total return, including dividends, of over 50%, which blows the door off a lot of other funds, but not too much of a shock given Bitcoin's recent performance. For investors that are looking for some Bitcoin exposure, BTCI could help fill the need with its sky-high yield, its nice payouts, and the nice mix of income and growth for someone that's bullish on Bitcoin. Next on the list is spyi, the NEOS S&P 500 High Income ETF. This fund aims to deliver reliable, high monthly income in a tax-efficient way, while also offering the potential for capital appreciation. The benefits of spyi strategy include combining S&P 500 exposure with a data-driven call option strategy, which allows spyi to generate that high monthly income for you. Second is that it takes advantage of tax loss harvesting opportunities, along with index options that are favorably taxed. And lastly, spyi uses a call option strategy that may include both sold and bought S&P 500 index options that can offer the potential for capital appreciation. As for the fees, spyi comes in just a bit high with an expense ratio of 0.68%, costing you $68 for every $10,000 invested. spyi contains around 511 holdings in total, with its top holdings in companies like Nvidia, Microsoft, Amazon, and Google. And the sectors that make up spyi include technology up top, financials, consumer discretionary, and communication. The allocations and holdings in sectors are similar to what you'd see in an S&P 500 fund. For dividends, spyi has a dividend yield in the double digits of over 11%, which is paid out monthly. And the payments that spyi has provided over the past have been very consistent and stable. Can't complain at all here. The returns for spyi over the past 3 years have been great, with annualized total returns of over 13% since its creation in August 2022. spyi provides consistent and stable high monthly income along with tax benefits. It's shown some solid long-term returns in these past few years, and the combination of all these things show that spyi is a high-yielding ETF that you don't want to sleep on. Now, if you want to see some more of the best ETFs that pay monthly dividends, then check out this video here. Or if you want to know about 2 ETFs that could beat the monthly ETF JEPQ, then check out this video right here. If you enjoyed the video, don't forget to like and subscribe for more content Keep on investing, and I'll be seeing you on the next one.